Good evening, everybody. So good to see everybody here. Just like always, it's about 3 minutes after, and knowing the military in me, I like to keep us on track for tonight. We've got a wonderful presentation, and it's just fantastic to see so many people here together. I think actually this is our largest event that we've been able to have since COVID, so it's nice to get back together as a family and share our economic update tonight on what we'll be going over. I know they were working a little bit on some of the video that we have here, if we have audio. And let's see if we have audio. So it doesn't look like we have audio for that. Maybe we'll work on that and try to get that after the event. We'll share that with you. A really good video there. This is, of course, our disclaimer. Feel free to check over our disclaimers and can kind of look through that. Here's our agenda and what we're going to be doing for tonight. So tonight what we're going to be talking about is I'm going to be sharing the Retirement Guys formula and some of the strategy updates that we have. We'll also be talking with some of the special guests here tonight, going over an economic update. A lot of you are invested in different strategies that we have, whether it's our daily essentials, our capital strength, our Dividend Kings model. A good friend of mine for a long time, Joshua Crosley's here from Chicago talking with First Trust. Also, Bob Swann is here with us too, and we have a great relationship with him talking about how we're hedging equity. We've got Stephen Johnson's going to be talking in a little bit, a great partner of ours that we've worked with for 20 years from Allianz, sharing some ideas. And I think tonight's presentation is so timely with everything that has been going on in the economy. So I know a lot of you have reached out to me, you've asked questions. We're going to be here to answer those questions for you tonight. Because of the fact that we have a set agenda, it's going to be difficult for me to take a lot of questions. If we have time, I'll open it up for questions. But what I would encourage you to do is, everybody got a folder when you came in. Write down your questions on when you came in. And better than that, what you have on everybody's table is you have a QR code, which is one of the neat things that's really come pretty popular. I didn't know what this was until COVID, but you can scan this image with your phone, and what it'll do is it'll allow you to connect with any one of the speakers that we have tonight. And then for those of you that are here live at our event, afterwards we have 90 minutes where we're going to be able to enjoy the Beatles cover band and enjoy some great music together. It may be a little bit loud in here because of some music. We'll try to make sure it's just perfect for everybody that's in here. But for anybody who has questions, all of our speakers will also be outside in the hallway. We've got a couple of tables out there, so we'll be available if you want to come out and ask questions. More importantly, it's tough in big audiences to answer individual questions because we don't want to share your personal information with everybody else that's here tonight too. So you can always connect with us to just schedule a time where we can talk on the phone or get together and talk one-on-one. We started off this whole theme of love about a month ago. And about a month ago, we rented out Copper Moon Studio on Airport Highway. And we had an event called Remembering Our Loved Ones, which we had an opportunity to make a piece of glass artwork in remembrance of anybody who had lost a loved one. Or if you're like me and a guy and it's February 14th and you're like, uh-oh, it's Valentine's Day, what can I do to bring something home? We were able to get a piece of glass artwork to bring home. If you made glass artwork with us tonight, you can see Jenny or Courtney. We do have your glass artwork here we brought with us tonight. You can take home your glass artwork with you. You'll notice also next to the glass artwork, what we also have is we have a couple of buckets for some of the giveaways tonight. We have dinner dates, we have a stay at the hotel, we have a bunch of really neat packages for giveaways. The giveaways are a thank you for anybody who has brought somebody here tonight and or referred somebody in the past. I did my best trying to remember who to give tickets to, but I am human and I'm not perfect. If for some reason you've introduced somebody to our firm and you didn't get a ticket, please let us know. We'd be more than happy to give you a ticket. We really, really love it when you guys introduce people to us. And that's about 40% of our new business is through introductions from great clients like you. So that was one of the ways that we wanted to say thank you of giving back. So again, if you didn't get a ticket and you've brought a referral, please make sure you stop and see the ladies. They'll get you a ticket. The other thing that I can ask is a lot of people, use the internet to find out about our firm and our services. If you scan the QR code, not only can you connect with the speakers, if you could take 30 seconds and simply rate and review our company, if you love what we're doing and you want to share the experience here at America's Retirement Headquarters, we would really love it if you just took 30 seconds and left a review for us. If you do leave a review, I'd also encourage you to stop by, ask the girls, you can get another ticket and drop it in the bucket. Make sure on the ticket you put your name on it because you don't have to be present to win. We'll draw them after a while after the band plays. And if you decide to go home, that's okay. But put your name on the ticket so you have your name so when we draw that, we have that. We also will be talking a little bit about reliable income, and we'll also be then sharing a story about the ultimate estate planning checklist. So we have a full agenda lineup for tonight. Housekeeping rules are really simple. We're going to have dinner as we're doing the presentation. Feel free if you want to get up and get a drink, make yourself at home. If you need to use the bathroom facilities, they're out to the left. And if I could just ask a favor, if you have a cell phone, if you could just simply turn your cell phone off or on vibrate, that would be really great because it's really disruptive to me and all the other speakers and the other attendees if you answer your phone or your phone's ringing. At the same time, I understand that in the world that we live in, sometimes you had to take a phone call. That's not a problem. If you had to take a phone call, I just ask that you step out in the hallway and take your phone call out there. So when we look at a couple of different model updates, I think it's very important to understand what the methodology and what the philosophy is that we have here with our Retirement Guys formula. And what we've done is we've broken down our models into a couple of different categories. Some of the categories that we have are what I would refer to as strategic asset allocation type portfolios. These are portfolios where what we're trying to do is we're trying to identify companies that are extremely strong and companies that maybe want to own for a long period of time or forever. As an example, our daily essential portfolio is made up of companies that are products and companies that you would use every single day regardless of what's happening in the economy. So whether the stock market is up, whether we're in a recession or whether there's a war, every day I'm getting up and I'm using Colgate, right, to get ready in the shower. I'm putting my Hanes underwear on. I go to the table. I get my General Mills cereal. My wife would ask, hey, I'm going to Kroger's this week. What do you want from Kroger's to eat for the rest of the week? And maybe if it's a Thursday night in the summer and I'm playing golf, I have a Coors Light with my golf buddies, right? Copy, repeat process. The daily essential portfolio is a really good portfolio that is fairly defensive in different environments like what we have right now. And again, it's good companies that you can own for a long period of time. The capital strength portfolio is a portfolio that we work a lot with Joshua and First Trust. And what we do is we screen companies that have extremely high cash balances. So you have to have over $1 billion of cash. You have to have less than 30% of debt, and you have to have greater than 15% return on equity. So when we think about the stock market and you think about how does an investor lose money in the stock market, it's really one of two ways. You buy an investment and it goes down in price and you sell that investment. That is a good way to lose money, and it's a painful lesson that investors unfortunately do over and over again. Now thankfully, with so many that are here working with us, our job as your advisor is to coach you through that tough time and talk to you about what you own and hopefully be able to not make that emotional short-term decision that can hurt your long-term process. The second way you can lose money in the stock market is if you buy an investment, it goes down in price and it files bankruptcy, you typically lose your money. So Kmart, when they filed bankruptcy, they wiped investors out. Toys R Us, they wipe people out. If we're buying companies that are cash rich, that have low debt and good return on equity, we feel that these companies have the ability to weather through some of the storm. So if there is a storm coming, we're already prepared for it in some of the model portfolios that we put together with how we've built out those strategies. The next part of our strategies that we have are more tactical portfolios. So what a tactical portfolio means is it gives us the ability to take and push down the gas pedal when things technically look good, and then we can let off the gas pedal and slow things down when things technically turn negative. So what we're looking at is we're looking at various indicators of the market overall. One of our most popular tactical portfolios is Dividend Kings. And Dividend Kings, Bob and I have been working on together, but we have about 60% of the portfolio in some of the best strategies, in my opinion, that we've selected to give us large, medium, small, and international exposure. And then we use about 40% of the portfolio that allows us to be somewhat tactical to where the overall market's going to go. The other part of the portfolio that we have is called our Iron Retirement Series. What we do with Iron Retirement is once a week, each and every week, we look at the moving averages of the market. If the index is above the moving average, we would either stay invested or buy into the market. As the moving averages move lower, we would move out of the market and move more defensive in different approaches that we have. We also have a strategy called Protected Equity, which I'll show you a visual of what that looks like. But what it is a way to allow you to continue to stay invested in hopes that the market continues to go up, yet have more downside protection if and when the market goes down. I'd also say with technical analysis, we're looking at technical indicators. So it's like using a GPS to guide us on where we want to go. But we, the retirement guys, and our investment team, we still are human beings and can make investment decisions based upon where we see things at from an economic position. Again, giving an example of a discussion that we have on our monthly investment committee meeting, in November last year, we felt that risk was elevated overall in the markets. With Iron Retirement, we had already accomplished what we had set out to do with our goals. And in October of last year, we began to pull back our equity position and become more defensive. Now, going into this year, that proved to be a good strategy because the market has been a little bit volatile since November, and now we're able to take a look and decide when is a good time to be able to put that money and redeploy those assets to put it to work. So just know that we take our job at the Retirement Guys extremely serious. We have an incredible team that serves on my investment committee. Many of them are here tonight, that you have an opportunity that you get a chance to hear from some of the people that are from out of town. I'd encourage you, if you're not familiar with what your strategy is, what you really own, and what your methodology is, please take time to spend with me, Scott, Chaz, Jeremy, or your advisor to have a better understanding of your investment approach. I think it's going to help you weather through the storm, knowing what you own and knowing the reasons why you own and knowing what the game plan is. And that's what we're here to help you with in our model updates. So again, going over the things that we love, when we screen and we do an analysis, what we try to take a look for is we look for investments that we love, hence the theme tonight, love. So in the large cap category, again, we start with a basket of, say, 500 stocks. The first step that we do is we say, which of these companies do not have more than $1 billion of cash in their bank account? The next thing that we do is anybody who doesn't have that gets eliminated. The next thing that we're going to take a look at is which of these companies have greater than 30% of long-term debt. So again, another group gets eliminated. The next thing that we do is we take a look at companies that have greater than 15% return on equity. So what that list does is that list might go from 500 down to 70. So we're buying 70 of what we consider to be some of the most financially sound companies in the industry right now. Then, through our team and our relationships, we would further refine selecting maybe 40, 45, or 50 of the ones that we love. So we would take a look at that 70 list. Each and every month we take a look at those. We also use research from Morningstar where we're looking at valuations. When we're looking at valuations, what we're trying to do is we're trying to identify things that are expensive. And we want to stick with the basics of investing where we're trying to buy low and sell high. And Morningstar does a pretty good job with giving us valuations. And it's easy to get caught in the trap of chasing hot investments and overpaying for some things. Volatility, and I've heard from some of you and others about the concern of volatility here in the last 3 months. And look, I get it. Again, we take a ton of responsibility in managing your portfolios, but if you can step back from the short-term emotion, what actually this volatility does, it can create tremendous opportunity. So again, we've seen this happen time and time again, and with some of the pullbacks in the market, it gives us a lot more to be able to shop for, to be able to put into the portfolio to build some strength with the different things that we love in our models. So one of the things that I like to do is I'd like to kind of, dive behind the scenes. And Bob, I'd like to have you come up and we could talk a little bit about what we're doing with Swann and our hedged equity. And I should say Rob. Bob, Rob. This is live right here if you want to use that one.
Okay.
So what we have done, and I think this is something, again, this is very unique that our firm does that you don't see in a lot of other places. And what we began doing is we had met last summer in April of last year. And we sat down in Florida, which is where they're located at, and we had a conversation. And we had a conversation about the markets, where they're at, the risk that the markets present. And we had talked a little bit about the concern of how to hedge the overall strategies. So when I say the word hedge, number nerds like me sometimes get it, but I think a lot of us maybe that are here tonight, they don't understand. And so any of you that have a model called our King's portfolio, this is where you're going to see some of the hedging that is at. But if I started with that question, Rob, I said, what the heck is hedge? What would you say?
Well, the first thing I'd probably say is that I wouldn't get confused by the word hedge. Hedge sounds like a hedge fund, and hedge funds usually are taking on a heck of a lot of risk, and they're trying to really shoot for the stars and get a lot of returns by taking a lot of risk. Funny thing is that most hedge funds don't have a hedge. Swann, on the other hand, believes in always being invested and always hedged. And the best way to think about that is really it's just like an insurance policy. You're hedging, you're insuring most of the important things in your life. You're hedging your car, your life, your health, your house. Your house may never have burnt down, but you basically are paying for insurance on your house every single month, every single year. And we believe that with a portfolio, that is probably the most important asset you have. That's what's going to give you the opportunity to retire, to enjoy your life, to do the things that you really enjoy doing. And basically, we believe in always being invested because we can't time the markets, and we believe in always being hedged. So if you have the right insurance policy, even though we're not buying insurance, we're putting in place a hedge on the portfolio, really with recognition that the large declines in the market are really what do damage to the portfolio and can take years to recover. So we're all about positioning ourselves with the right protection on the portfolio so that we do not have to sell low like you're talking about and realize those losses, but instead we're positioned in a great spot to basically weather that storm and to provide a smoother ride.
So we have our YouTube channel. And another thing I would encourage you to do is anybody here who is not subscribed to our YouTube channel, most of the time people say put your phone away during presentations. We're just the opposite. We actually encourage you to use your phone. So whether it's scanning that QR code that we talked about and connecting and asking us questions during our presentation, you could do that. Another thing is if you use your phone, if you go to YouTube, you can type in America's Retirement Headquarters on YouTube. You can subscribe to our YouTube channel, and on our YouTube channel, what you would find is every week we put out 30 minutes of a video podcast talking about a particular topic. Rob and I have recently done a 30-minute show, so if you like what he's talking about, we've got 30 minutes more where we're discussing this. The other thing that I would say that I wanted to point out about our video series is under our playlist, we have something called the Minute to Win It series. So Minute to Win It was just quick 1-minute ideas that I was throwing out there talking to investors when COVID was happening. And one of the questions that I had posed, and it's a question that I've started to hear a little bit more, is This time it's different. Should I just go to cash? What would you say based upon, the Swann philosophy?
Well, I think that if you've got the right hedge in place, if you've got the right protection in place, then you don't need to go to cash. I think that you mentioned investors overreacting and using their emotion, and they end up selling at the wrong time. They end up selling at the bottom, and then they wait to get back in until the market has already recovered quite a bit. So our whole goal is to allow you to weather through that period of time because you have the right protection on your portfolio. We've smoothed the ride. One of our clients pointed out to me that our name Swann could stand for sleep well at night, which it took a client to point that out, but it's really directly in line with what we believe. We can't time the market. I know people who basically said the market was topped out and couldn't go higher than in 2013, and look where we are today. So we think it's really important for investors to be able to stay in, we like the idea of buy and hold, but we want to really smooth that ride, and I think that that's what you are trying to do, is really provide people with a smoother ride, and you're trying to take that worry and that concern off their plate.
We really are. So, in all of the portfolios, if you look around, you guys are the people that we work with that are close to or in retirement time, and we really do understand that we want to try to have the smooth ride. That doesn't mean that the stock market's not going to go up and down, and you can't control all the volatility in the market. But by hedging some of the overall volatility in the market, we can try to help narrow in what I would call some of those guardrails that you have within the portfolio. I would say that my kids, Andrew's in the back. Actually, Andrew, raise your hand. There he is. If anybody's followed Andrew growing up, Andrew is at Bowling Green State University. He made the dean's list just recently, so he's doing really well. He also was, on Saturday, he got together with all the Eagle Scouts in Northwest Ohio that earned their Eagle Scout rank last year. He became an Eagle Scout. And his brother might be here somewhere. His brother's at Anthony Wayne, just finished up hockey season, and is working on a promotion. He gets promoted next week in Scouts to star rank. So they're doing really good and kind of growing up quickly. When we look at different things, again, trying to hedge and looking at the guardrails and looking at like what Andrew does a lot of some of the portfolio analysis that we have with our clients. Every client that's here, we have developed a portfolio investment statement for you. And what that does is that kind of gives us the parameters of what the outcomes could be with the overall markets and normal market conditions. So if we looked at your portfolio every 6 months, we can tell you mathematically within about a 95% probability what the outcomes could be within the portfolio. So if you haven't looked at your risk score lately, again, get together with me or your advisor, let's take a look at that. The other thing that I would tell you is once we put that in Riskalyze, one of the other things that we have been working on, Rob and I have been working on together behind the scenes, is once you have your portfolio inside of this, it allows us to stress test it. So what we can do is we can make your portfolio jump on the treadmill and run as fast as it possibly can and see how it would perform if and when there's another market crash. Then we can give you some of the outcomes of what the maximum drawdown is. The other thing that I think is important to share is the topic we'll talk a little bit about tonight, which is rising interest rates. And so you and I have already begun working on this. This was probably 6 months, if not 8 months ago, before the Federal Reserve has indicated that they're planning on raising interest rates. And they're planning on raising interest rates as soon as this month. So why don't you share a little bit about why hedging, maybe some of the protected equity strategies, and what your thoughts are with rising interest rates and the traditional fixed income asset allocation approach.
Right. So when we started the strategy back in 1997, it's called hedged equity. It was all about protecting equity against the major losses and against bear markets. It was recognizing that those bear markets could do tremendous damage to the portfolio. At that time, interest rates were still coming down, and fixed income bonds in a portfolio played an extremely important role, and they have for over 40 years. We've been in a decrease in interest environment for a long time, and bonds have strongly performed and have provided diversification in the portfolio. In a normal, you've heard of 60-40 portfolio. Well, it would be 60% equity and 40% bonds, and those bonds really provided a lot of diversification and protection, non-correlated returns when maybe the stock market was going to be selling off. Those bonds have also delivered over that 40-year period in that 7 to 9%, a nice steady return, good returns. Now that's not the case anymore, and we're starting to see that hedged equity as an alternative can provide some better returns. Our returns over those 25 years is right in that 7 to 9% over every 10-year period. And so we're seeing a lot more interest in hedged equity as an alternative to bonds now that bonds are delivering so low in terms of the performance, but also, as you point out, have a lot of challenges. If interest rates do go up, then those bonds can go negative, and you could end up with having negative returns in your bonds and negative returns in your stock. And so hedged equity, I think, is proving to be effective, almost like salt in a recipe, where you could put it on your steak, and you could also put it in your cake, and it basically has an equally important aspect and performance in the portfolio.
Yeah, so something, again, that we've already been working on, going back to last fall, stress testing the portfolio, looking at the impact of rising interest rates. And we began executing that strategy here recently, trying to buy on some of the opportunities when we got together earlier in this first quarter and began to reposition, some of our fixed income assets into more hedge strategies. And again, that's where I'm talking about what we were looking at as the Retirement Guys formula, is where to be able to take advantage of the opportunities that are out there. So volatility, if we can take our short-term emotions out of it, actually creates great opportunity. And Rob Schwab and his company are able to kind of help us do that. So because of the fact that I'm a little bit limited on time tonight, what I would encourage you to do is, again, go to our YouTube channel. We've got a 30-minute discussion up there where we're talking more on this topic. Or better yet, I talked him to fly from 85-degree Florida weather to come up here to Northwest Ohio, right? Because it's nice and warm up here in Northwest Ohio. So take some time after dinner, myself, Rob, and all of the speakers, if you want to come out and chit-chat with us, ask any more about how we're hedging the portfolios, feel free to ask tonight. Or again, if you want to just scan that QR code, you get direct access to the YouTube channel on there, and also you can connect with our speakers by scanning that QR code. So any final thoughts maybe before I switch gears?
I guess one final thought. I think now more than ever with the challenges in the market, I mean, we've got not only rising interest rates, low yields in bonds, we got stock markets at all-time highs, we got inflation, we got geopolitical risk. It's more important than ever to be trusting in America's Retirement Headquarters to be really delivering and researching and providing a good defense. I know Bear Bryant basically said, offense wins games and defense wins championships. And that's what you guys are doing, and we're proud to be a part of your team.
Yeah, thanks. I appreciate you taking time coming up here.
Sure thing.
So this is an example of another strategy that we've worked a lot with First Trust in our overall approach that we've had and being able to build some protection into the portfolio. What this is called a buffered ETF. So again, it works a little bit different. I know Swann has some strategies that work like this, but essentially what a buffered ETF does is it allows you to put a certain amount of losses over a set time frame, in this case typically 1 year, if and when an underlying investment goes down in value, so you have more protection on the downside, but also allows you to participate if and when the market goes up to a certain cap. Again, a great strategy for those investors that are looking to still be able to participate in some growth up to a cap, but be able to try to minimize and limit some of the downside risk. And I can't think of three more intelligent people that are here tonight, which is Allianz has this approach, First Trust has this approach, and also Swann has this approach. So again, if you're looking for some downside protection, you've got great speakers and people here tonight that can talk to you about protected equities for downside risk management. So if we dive in and we look at the economic update, what this chart shows is the last 20 years. The darker colored lines show how the stock market ended up after the calendar year. But it may be hard because there's so many people that are at this event tonight, but what you'd see on the bottom is you'd see red dots. And the red dots would indicate that the time throughout the year, what the pullback was overall in the market. And so what you would notice on this chart is if you looked at it closely, is you would notice that 70% of the time, the stock market on a yearly basis has had a 10 or 15% pullback. So those of you that are wondering, is now, right now, Nolan different? History would say it's not. History would say that 70% of the time, what we're experiencing right now is normal volatility within the market. Now, if you notice, if you took advantage of buying, and nobody can buy at the perfect red dot at the bottom, but if you try to take an opportunity to get some of the things when they're down, what you'd look at is at the green line, most of the time those years that the market came back. Of course, you can see that the big down year that we can see in 2008 where the market had a significant decline overall, which again is why we want to hedge some of the overall strategy. But volatility is normal. It gets difficult when the market just gives us up, 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 month after month. That's not normal. For those of you that were here at the Great Debate, how many people have been to an economic summit before? Okay, so how many people are first-time attendees in an economic summit? Okay. So a lot of you were here and you heard me on the Great Debate talk about the election results. And the one thing that I shared about the election results is if you looked at most of the media that was out there, what they had expected is that if Trump didn't win re-election, they had expected the market was going to have a 15% sell-off or some type of decline. The reality is the market didn't have a sell-off. The market actually had a great year, and it wasn't until just recently that we had volatility. So short term, nobody can control the stock market. That's one of the most popular questions that people will ask us is they'll say, okay, what do you think the stock market's going to do over the next 3 to 6 months? And the answer to that is we're willing to share our opinion, but the reality is the stock market doesn't care what my opinion is, nor did most economists get it right with the election because the markets actually performed well during the first year of the Biden presidency. What that would tell us is that we should focus on the things that we can control, things like keeping investments low cost, which is why I love working with Charles Schwab because their mission is to be the lowest cost investment company in the industry. It's why I love picking stocks that pay good dividends and interest so you have predictable income. But the other thing that you can control as an investor is you can control looking at buying opportunities when everybody else is panicked. And I'm not necessarily saying that we're in a complete panic phase right now, but there are starting to get some opportunities. And if we use this chart, what history would tell us is that there are starting to become some good buying opportunities if we're smart and intelligent about what we buy with what time frame and how long we plan on owning that investment. One of the investments that I've also worked a lot with was Dr. Robert Schiller, which is the double-line Schiller index. This index was created based upon the Nobel Prize winning philosophy of Dr. Robert Schiller. And I had the opportunity to talk with Dr. Schiller before COVID on CNBC's Closing Bell. In fact, I got invited to go to Yale in March of 2020, which was going to be great because I could say to people I had my Yale jacket, I went to Yale, you know, but that got shut down. So the reason I bring this chart up here is Dr. Schiller won the Nobel Prize in economics. We have a ton of smart people and team that we work with, but I haven't won the Nobel Prize yet. Dr. Schiller has, and if we look at his price to earnings ratio, what I would show you here is that the market is still at a very elevated risk, even with the recent pullback that we have based upon the Schiller index. So again, we have to be smart and intelligent about what we own. Broad markets as a whole tend to have risk right now that's associated with them. So selling on emotion can be costly. Again, the probably worst phrase I can ever hear an investor tell me is this time it's different. What this chart shows here is this chart shows the stock market over roughly the last 10 years. And whether it's Ebola, The United States debt got downgraded for the first time in the history, a couple of years ago. We have debt ceilings that we've run into. There's always been a reason to sell. There's always been a reason to sell. And if you look at this chart, if you allowed your emotions to allow you to sell and wait till things got better, you would have missed out on a nearly 500% increase in the S&P 500 index. Now again, the S&P 500 index is an unmanaged index and you cannot invest directly into it, but it just shows the power of what equity growth can do over time. And there's always news and there's always reasons to allow your emotions to get involved to harm your short-term decisions. The short-term decisions that you make can cost you in the long term. So don't sell on emotions.